Okay, today we're going to review the recommendations since the blog has started and just do a comparison of the blog portfolio versus the S&P 500 and get an update on the stocks that were recommended. I think the fairest way to do the comparison of the recommendations is to compare it versus the benchmark S&P 500, which is the green line here, and we're going to consider that someone invested in the recommended stock the day after it was recommended on the blog post. So the first recommendation from October 30th was Whirlpool Corporation, and since that time we can see that Whirlpool has been a big outperformer, returning 35.13% compared to the S&P returning 7.2% over that time period. So if you haven't already taken profits in Whirlpool, you probably should at least set a stop limit order to lock in some of those gains. The next recommendation is actually the only one that's underperformed, which is WellPoint, and it was recommended on November 7th, 2011, and it's returned negative 5.46% compared to the S&P returning 5.21% since then. However, I still think that WellPoint is at a very attractive valuation currently, especially considering its earnings history and low PE ratio, and it's actually even more of a bargain now, of course, since the initial recommendation. So I think it's still an interesting opportunity. For more details on WellPoint, please see its associated blog post from November 7th at this address here. PetMed was again another big outperformer, and it was recommended on November 13th, 2011. Since then, it's returned 32.29% compared to the S&P 7.24%. So similar to Whirlpool, if you haven't already taken profit, you should probably set a stop limit order with PetMed. Nidec Corporation was recommended on November 28th. Since then, it hasn't actually kept pace with the S&P 500, but nonetheless, it returned 9.01% compared to the S&P returning 12.07% since that time. Exelon was recommended on January 16th of this year, and this is a utility company, so it was added to bring down the risk of the portfolio, as it's a low beta stock, and it's currently still at an interesting valuation since it hasn't really moved at all since it was recommended. However, it has a very significant yield of over 5%, considering that 10-year treasuries don't even yield half that. So Exelon is still a interesting conservative investment for the portfolio. Total was recommended on January 22nd. Since then, it's returned 4.05%, while the S&P has returned 2.23%. The last recommendation from January 29th for the blog was Vale, which was an instant success. It's returned 7.43% in just 1 week, compared to the S&P returning 2.41% during that same time period. So, considering the current status of all of the blog recommendations, it's performed very well and actually outperformed the S&P 500 during that time period. And in the case of Whirlpool and PetMed, of course, significantly outperformed. But otherwise, still considering all of the stocks recommended has outperformed the S&P by over 6%. And again, WellPoint is the one which had underperformed, but I think is the one that's actually still a good opportunity now if you want to look back at that blog post. That sums it up for this edition, and remember to check the site here for the next post. Thanks. Bye.